You have $1,000 to invest. You find MetroCoffee, a strong, recognizable brand with a dividend that pays you almost 10% a year, nearly $100 for doing nothing. The stock is down to just $10 after a recent crash, so you buy it. You tell your wife and your friends. You feel smart. 1 year later, the dividend is gone and the stock price drops 40% in just 2 weeks. Your $1,000 is now worth $600. It is past midnight, your wife is asleep, and you are now sitting at the computer staring at the stock chart, trying to understand what went wrong. Not just for yourself, for her and your newborn, for the life you are trying to build together. But the answer was not in the chart. It was in 3 numbers hiding in plain sight in the cash flow statement. Numbers that would have told you in 30 seconds that this dividend was never going to last. Hi, I am Nick, the guy with a Greek accent and a long-time value investor. I like dividend-paying stocks. And at the beginning of my investing journey, the dividend yield was all I was looking for. A high number next to a familiar name. That felt like enough. Luckily, I found Benjamin Graham and Warren Buffett. Buffett had a simple question he asked before buying anything. How much cash does this business actually produce for its owner? Not the profit on the page, the cash in the hand. That question changed everything for me. In the previous videos, we opened all 3 financial statements of MetroCoffee. The balance sheet showed debt rising for 4 straight years to $120 million. The income statement showed $100 million in profit, reassuring. The cash flow statement told a different story. MetroCoffee borrowed money to pay the dividend. Without that loan, the dividend would have been cut immediately. Today, we do a calculation on the numbers shown in the cash flow statement. We calculate free cash flow. You will not find this number anywhere on a company's financial statements. Companies are not legally required to report it. It is a number you have to calculate yourself. And that is exactly why most investors never see it. If you are new here, subscribe. Every video in this series is one more step toward becoming an intelligent investor. Free cash flow is the cash a business generates simply by operating after paying for everything it needs to keep running. Think about your own life. You earn $3,000 a month. Rent is $1,000. Food, $300. Car payment, $200. Things you cannot avoid. That leaves $1,500. But your car needed new brakes, $400. And your washing machine broke, $600. You wrote both checks. What is actually left? $500. This is your free cash flow, the money you can truly do something with. Save it, invest it, or give it to your family. You choose to invest it in your education, a professional course, $400. Not because you had to, because you wanted to earn more next year. Now, what is actually left? $100. That is the difference between maintenance and growth. The brakes kept your life running. The course was a bet on the future. Both came out of the same pocket, but they mean very different things. That $500 before the course, that is what Warren Buffett calls owner's earnings. Not your salary, not your gross income, the cash left after the world took its share. Now imagine your neighbor. Same salary, same neighborhood, but every month he is borrowing from his credit card to pay his bills. From the outside, he looks fine. Same car, same house, but he has no free cash flow. And one day, the credit card runs out. Companies work exactly the same way. MetroCoffee is that neighbor. We open the cash flow statement. 2 numbers is all we need. The first one, cash from operations. $180 million. This is the cash MetroCoffee generated simply by selling coffee, running its stores, doing what it does every day. The second one, capital expenditures, $150 million. This is the cash MetroCoffee spent on its physical business, replacing worn-out espresso machines, repainting stores, keeping 3,000 locations running, but also opening new ones, expanding into new cities, choosing to get bigger. Free cash flow equals cash from operations minus capital expenditures. But before we calculate it, there is one thing you need to know. Not all capital expenditures are the same. Think back to your personal story. The broken brakes, it was no choice. The course, it was your choice. One was the cost of staying alive. The other was a decision about the future. Businesses work the same way. Some capex is maintenance, replacing a worn-out espresso machine, repainting a store. Things MetroCoffee must spend just to keep the doors open. If they don't, the stores deteriorate. The customers leave. Some capex is growth, opening new locations, entering new markets, things MetroCoffee chooses to spend. Free cash flow wants to know what this business produces as it stands today, before any decisions about tomorrow. So, ideally, we subtract only the maintenance capex, not the growth. But the cash flow statement does not separate the two. It shows you one number. So, how do you find the split? There are three ways. The first, read the annual report. In the United States, it is called the 10K. Every public company is required by law to publish one every year. It is the most complete picture of a business that exists. Financial statements, footnotes, risks, strategy, all of it, free, available on the company's website. Companies sometimes break out maintenance and growth capex in the footnotes. It takes time to find, but it is there. The second, listen to the earnings call. Every quarter, management sits down with analysts and answers questions. Sometimes an analyst asks directly, how much of your capex is maintenance? And management answers. These calls are free, available on the company's website. The third, subtract everything. Treat all capex as maintenance. This is the solution I prefer when the first two reveal nothing. It is conservative. It makes the company look slightly worse than it might actually be. But that is the point. Benjamin Graham called this the margin of safety. When you are uncertain, assume the worst, not the best. Because if you assume the best and you are wrong, you lose money. If you assume the worst and you are wrong, you get a pleasant surprise. For MetroCoffee, we will do exactly that. Subtract everything. $180 million minus $150 million equals $30 million. That is it. That is the money MetroCoffee had left after running its business, after maintaining its stores, after funding its growth to do whatever it wanted with. And what did MetroCoffee choose to do with it? Pay its shareholders a dividend of $100 million. $30 million in, $100 million out. That is not a dividend. That is a promise that cannot be kept. The free cash flow payout ratio tells you exactly how much of free cash flow a company is paying out as a dividend. The calculation is simple. Divide the dividend by the free cash flow. $100 million divided by $30 million. 333%. A healthy business pays out somewhere between 40 and 70% of its free cash flow as a dividend. That leaves enough cash inside the business to grow, to maintain, to survive a bad year. MetroCoffee was paying out more than 3 times everything it had. The only way to do that is to borrow, and they did. We saw it on the balance sheet. $120 million in rising debt over 4 straight years. The cash flow statement showed a fresh $70 million loan. As intelligent investors, when we analyze the financial statements of a company, we are looking for things to say no to this investment idea. MetroCoffee has a lot. The balance sheet said no. You already know why. Debt rising for 4 straight years. Debt to equity over 1. Stock price almost 7 times the book value. The income statement said maybe. Profit looks fine on the surface. The cash flow statement said no. Borrowed money to pay the dividend. The free cash flow said no. $30 million to cover a $100 million promise. The free cash flow payout ratio said no. 333%. Not even close. Everything we just found, the balance sheet, the cash flow, the free cash flow, the payout ratio, is in the MetroCoffee case study you can download, link in the description. But despite all these no's, we aren't done, because we are here to learn. And as an investor, you never make a final judgment based on a single snapshot. So far, we only looked at 1 year. 1 year can lie, a bad quarter, a one-off charge, a lucky windfall. In isolation, any company can look broken or bulletproof. But 10 years cannot lie. Patterns do not lie. The skill is not in reading a number. It is in seeing its pattern over time. So that is exactly what we do in the next video. We go back 10 years, and from all the noise, we focus on the 6 numbers that actually matter, side by side across a decade, to understand the trend. Because the truth about MetroCoffee was never hidden. It was in plain sight, written across a decade, waiting for someone who knew how to read it. Click the video on your screen right now, and let's go find it together. Because this was never about MetroCoffee. It was about making sure the person asleep down the hall never has to worry.